Hello, everyone. I'm Miles. Today, we're going to work through a classic corporate finance case to really understand how financing choices impact shareholder value. Here's the case. ABC company has 1,000 shares, each with a book value and cash of $1,000 and no debt. The company needs to raise another $100 to invest in a project, which is expected to yield a 25% return in the first year. The company has two financing options. First, equity financing. Issue 100 shares at $1, paying a 1-cent dividend. Second, debt financing. Borrow $100 at a 10% interest rate, with principal due in a lump sum after 10 years and no dividends paid. Let's use 3 financial statements to project results at end of first year. First, equity financing. Income statement. Project revenue is 25. Interest is 0. Pre-tax profit is 25. 20% tax on pre-tax profit is 5. And net profit is 20. Cash flow statement. Starting from net profit of 20, operating cash flow, CFO, 20. Investing cash flow, CFI, 0. Dividends are 1 cent times 1,100 shares, equaling 11. Financing cash flow. CFF issuing shares brings 100 minus dividend payments 11 equals 89. Total cash flow 20 plus 89 equals 109. Ending cash balance 1,000 plus 109 equals 1,109. Balance sheet assets cash 1,109 liabilities 0 shareholders equity paid in capital 1,100 retained earnings 20 minus 11 equals 9 total shareholders equity 1,109. Per share value. Book value per share 1,109 divided by 1,100 equals 1.008. Add a dividend of 0.01. Total per share value 1.018. 2. Debt financing. Income statement. Project income is 25. Interest is 10. Profit before tax is 15. Tax at 20% is 3. And net profit is 12. Cash flow statement. Net profit is 12. CFO is 12. CFI is 0. And debt financing is 100. So CFF is 100. Please note, the $10 interest payment is already included in the operating cash flow, CFO, and does not need to be counted again in the financing cash flow, CFF. CFF only accounts for the raising and repayment of debt. Total cash flow 12 plus 0 plus 100, 112. Ending cash is 1,000 plus 112 equals 1,112. On the balance sheet, cash is 1,112. Liabilities. Debt is 100. Shareholders' equity is 1,000 plus 12 equals 1,012. Per share value of shareholders' equity is 1,012 divided by 1,000 equals 1.012. Total per share value is 1.012. Key takeaway. In the first year, equity financing has a slight edge because there is no drag from debt interest and the dividend is minimal. Even though shareholders face dilution, the total per share return is still slightly higher, 1.018 versus 1.012. Debt financing may be attractive in the long term because of the tax shield and no dilution. But in the first year, interest expenses and taxes reduce its advantage. When might debt financing outperform equity financing? If the project has a high rate of return and equity dividends are substantial, or if debt interest is very low and equity requires significant dilution. In reality, secondary equity offerings are usually priced below market value, so more shares need to be issued to raise the same amount of funds.